we are going to look at section 2, section B of the question. Now, section B says what required sales revenue is needed if the owner wants a what? An 80% return on his investment. Prepare a contributory margin income statement to confirm the what? CVP calculation. Now, first thing we'll do, in this case, we are going to what? Find the return on investment that the person need. And that is what? 80% of 450,000 was 18 to $81,000. Alright? Now, to do this, to find the break-even sales level which is required, the formula will be what? Fixed costs plus what? Return on investment. Remember that formula which you went through in the notes before? Divided by 100% minus what? 75%. Now in this case, the fixed cost is what? 169,900 and the return on investment is 81,000. Add them together get 290, 900 divided by what? 25%. Why? Because 100% minus 75%. Remember, this 100% represents what? The total amount of sales. Alright? And this 75% represents what? Your variable cost percentage, which you have done before. Alright? Now we divided 250,900 by 0.25, we get a required sales figure of what? 1,003,600,000. That sales figure now you would use to start your income statement, as you will see here. This is your contributor margin income statement. You have sales revenue of 1,003,600,000. You have less variable costs. Now, notice, and listen carefully, watch me carefully, please. The variable costs are really 38% of the sales. You follow me? 38% of the sales. So what you will do, you multiply 0.38 times 1,003,600. Do it for me, please. And you'll get what? 381,368. You multiply what? 27% times what? Remember that it is the 27% of what? Sales, right? So you multiply 27% by the 1,003,600. You get 279.72. You multiply 10% by the 1,003,600. You get 100,360. Alright, so remember, you must, if you're given a question like this, when you reach this point, you're going to multiply to get the 381,368. You're going to multiply the sales revenue by the what? Percentage figures to get the cost, the dollar value for the variable costs in this case, alright? Or for the contributory margin income statement. Then now, you're going to add up everything, you get what? Total variable cost of 752,700. Subtract the variable costs from what? Sales revenue. You get a contributory income of what? 250,900. Then you're gonna have less fixed costs, which is 48,000 before, 2,845, 3,000, 21,600, and $90,000. When you add up all of those, you'll be given a figure of 169,900. You subtract that from the 250, you get what? 81,000. That means that the amount of sales revenue that you got, it would be okay with all the fixed and variable costs that you have originally. The amount of sales revenue that you would have calculated would be okay to give the man a return on investment of what? 81,000. Alright. The last question on this document says discuss two assumptions built into CVP analysis. And there are a few right here. One, it assumes that the costs associated with present level of sales can be accurately broken down into their fixed and variable elements. It assumes that fixed costs will remain unchanged during the period affected by what? Decision being made. Thank you for listening to this clip, and please now go and try this question as uploaded in Moodle, please, and email to you as well. Please go and try this question now and have yourself a wonderful day.